Ron William. He's a technical strategist at MIG Bank. He joins us now. So, technical analysis of the gold markets. Ron, tell us what you're looking at in your first chart. We'll just bring up your first chart. Key trigger levels here for the price of gold. Take us through this.
Well, it's very important to look at the key levels, especially at a market which has done so well as gold, as everyone knows. And the key trigger levels to keep in mind are $1,600 on the downside and $1,530. Now, what I've been saying to clients is that a sustained weekly close below $1,530 will likely open up risk for gold's mountainous rise to potentially avalanche lower into a substantial decline.
So you're predicting that it could go substantially lower than 1530?
Yes. I mean, one of the key things that people could be watching is the 200-day long-term moving average, which a lot of trend followers and conservative kind of people in the market will be watching. If the market doesn't actually hold at the 200-day moving average, and keep in mind we haven't broken the 200-day moving average for 3 years, then that should unlock a much sizable move.
Let's just bring up your next chart, actually, so that we can show that 200-day moving average. 1,300 is the level that it could drop to.
Yes, 1,300, and a kind of even lower target than that would be 1,040 and 1,000.
Wow.
And that's actually also corroborated by long-term cycles that I watch closely. But the one thing to keep in mind is such a dramatic move, either target would still set up a very long-term buying opportunity for gold.
Here is the long-term chart as well. So you're saying if it does drop to that level that you said the markets indicate it will go to, then it's a good time to get in, because over the longer picture, what are we talking, 2 years? It'll go up?
We're talking in the next 6 to 12 months, so basically into the year 2012. And there is a historical potential repeat to 2008, when gold had previously hit around numbers such as $1,000, and it had moved sideways for about 8 months. So that's the rough guideline that people could be watching. Keep in mind that the chart we just looked at now for liquidity flows shows that a lot of the institutional money that has been going into gold all this time is actually under threat. Over 2 years' worth of long gold positions is under threat at the moment. So that would just put gold's bullish macro story on ice for some time.
That again backs up your analysis that gold will fall significantly.
Yes.
Let's move on and talk about the dollar, because you've got some calls on this as well. Dollar-euro, correct?
Yes, absolutely. And so the last time we spoke about euro's potential fall from grace, and we did hit the previous target. But now what we are seeing is a lot of this new search for safe vehicles to invest money is now being diminished. Swiss franc is no longer the safest place. Gold 20% down from its all-time highs, and so the US dollar becomes this rejuvenated safe haven at the moment.
What target do you give the US dollar versus the euro? When's it going to reach this higher level?
Well, the euro, I think, heads down back to 130, and then below that 126.70. And in terms of the US dollar index, I believe that continues on its course for a 30% increase in value over the next 6 months.
30% increase in the gold index over the next 6 months. Ron William there. Thank you very much.